Welcome to this explainer. Today we're walking through the absolute definitive, mathematically backed roadmap to building true wealth. Look, there's a lot of noise out there about what you should actually be doing with your paycheck. But if you want to know the absolute smartest order of operations for your money, step by step, you are in the exact right place. We're going to break down the precise sequence you need to follow to optimize every single dollar you earn.
Okay, let's dive into this. Have you ever noticed how many people are walking around carrying credit card debt at 22%, literally bleeding cash? And they're out there laughing at basic financial advice while trying to buy the latest crypto coin or pick the next Tesla? It's a massive trap. They're trying to run a marathon before they even know how to tie their shoes. Today, we're stripping away all that hype and focusing on the undeniable math of wealth building.
So here's our step-by-step rescue plan. We'll quickly cover the get-rich-quick trap, securing a defensive foundation, unlocking what I call your shadow portfolio, the triple tax advantage, maxing out your future, and finally, the smartest investing order.
Part 1. The Get-Rich-Quick Trap and Avoiding Financial Illusions.
There is an absolute flood of financial AI slop taking over our feeds right now, right? You've probably seen it. Faceless videos, robotic voices, mispronouncing basic terms, pushing drop shipping or flashy day trading strategies. It's just a low-effort distraction designed to grab ad revenue, but it's dangerously distracting everyday people. The truth, doing the boring stuff first is the actual secret to outperforming the market. Amateur investors love to skip the basics because, well, they aren't exciting. But professionals, they know that boring foundational math is what actually builds wealth. It's not about timing some miraculous stock pick. It's about consistently following a proven, completely unglamorous mathematical sequence.
Which brings us to Part 2. Securing the Defensive Foundation, Phase 1.
Before you even think about complex investments, you have to establish a rock-solid security base. If you try to build a portfolio on top of a shaky foundation, one unexpected life event is going to completely wipe out your progress. Step 1 is to build a starter emergency fund. According to Vanguard data, a basic $2,000 buffer is often enough to keep you from falling back on credit cards when, say, your car breaks down or a medical bill hits. Once that cash reserve is in place, you move immediately to Step 2, paying off high-interest debt. We're talking anything with an interest rate over 8%. Carrying 22% credit card debt while trying to earn 7% in the stock market, that's just financial self-sabotage. You have to aggressively kill that debt before you invest anywhere else.
All right, Part 3. Unlocking your shadow portfolio, the corporate wealth hack.
This right here is the core revelation of this entire explainer. There is hidden wealth sitting right inside your workplace benefits, and most people are completely blind to it. Most folks treat their employer like an ATM, right? You show up, extract your base salary, and go home. But you need to start treating your employer like a venture capital firm. Think of it like this. You are the portfolio company, you incorporated, and your employer is offering you investment terms that would literally make a Silicon Valley founder weep with envy.
Just let this number sink in for a second. 100%. When your company offers a 401k match, say they match your contribution up to 6% of your salary, that is a guaranteed 100% return on your investment the very second that money hits your account. There's no hedge fund manager on earth who can legally promise you a 100% guaranteed return. Yet, crazily enough, roughly 1/3 of employees walk right past this free money.
I want you to remember this quote. Your paycheck isn't the end goal. Your paycheck is seed funding for you incorporated. When you skip your 401k match because you think you can't afford it, you are literally ghosting an investor who is actively trying to hand you capital to fund your financial escape plan. Step 3 of our sequence is absolutely crucial. Capture every single dollar of that employer match. Do not leave venture capital on the table.
Moving on to Part 4. The Triple Tax Advantage Phase 2. Now it's time to route your money into accounts that the government has heavily incentivized you to use. These are investment vehicles with hidden superpowers. You've already done Step 3, the employer match. Step 4 is to fund a self-directed IRA. This gives you ultimate control of your investments with significantly lower fees and way better fund choices than a standard corporate 401k. But once that is funded, you move to Step 5, the Health Savings Account, or HSA. And I really need you to pay close attention to this one.
The HSA is, without a doubt, the greatest legal tax shelter available to the working class. Think of this as our little closely guarded secret. It is triple tax advantaged. The money goes in before it's taxed, it grows completely tax-free, and as long as you use it for qualified medical expenses, it comes out tax-free. Most people treat an HSA like a checking account just to buy Band-Aids and pay copays. Honestly, that's like using a Ferrari to drive down your driveway to check the mail. The real strategy is to max it out, pay for minor medical expenses out of pocket if you can, and let that account compound for decades.
Part 5. Maxing out your future.
Phase 3. After you've funded your HSA, you are basically in an elite class of savers. At this point, your foundations are set, your tax-advantaged buckets are working for you, and we take any overflow capital to fund your long-term wealth engines. Step 6 is to circle back to your workplace 401k. You already got the match back in Step 3, but now you want to max out the remaining legal contribution limit to fully reduce your taxable income. Once that bucket is filled to the brim, you finally reach Step 7, the taxable brokerage account. This is for any remaining cash. It doesn't have the fancy tax perks of the previous accounts, but it offers complete flexibility. You can access this money at any time without age restrictions or penalties.
And finally, Part 6, the smartest investing order, the full master plan.
All right, we have covered a ton of ground, and it's time to bring this entire strategic roadmap together. If you ever find yourself holding a dollar and wondering exactly where it should go, this is your ultimate cheat sheet. Number 1, get that starter emergency fund. Number 2, crush your high-interest debt over 8%. Number 3, grab all the free money from your employer match. Number 4, fund your self-directed IRA. Number 5, max out the triple tax advantaged HSA. Number 6, go back and completely max out your 401k. And finally, number 7, pour the rest into a taxable brokerage account. This is the optimal mathematical sequence to build wealth while the rest of the world is chasing flashy illusions.
I want to leave you with this one final critical thought. Are you building wealth when the math says you can, or are you waiting for when your feelings tell you to? Relying on emotions, getting distracted by FOMO, or trying to skip ahead to the fun stuff is exactly what keeps the middle class broke. Follow the math, execute the steps in order, and let compounding do all the heavy lifting. Thanks for joining me on this explainer, and I seriously challenge you to look at your accounts today and figure out exactly which step you are on.